Ladies and gentlemen, imagine this. In the dead of night, or maybe the middle of your morning coffee, the screens light up red, alerts screaming, numbers dropping faster than anyone can refresh. In just hours, $600 billion, that's billion with a B, vanishes into thin air, gone, wiped clean from digital ledgers, portfolios, dreams, and retirement accounts. Panic hits the feeds. The end of crypto. Bubble finally popped. This time it's different. It's over. People freeze. Some sell at the bottom in blind fear. Others watch in stunned silence as what felt like unbreakable momentum turns into pure chaos. And then, something shifts. The selling exhausts itself. Dip buyers step in quietly at first, then aggressively. Whales accumulate. Headlines flip from crash to rebound. The same market that bled $600 billion in hours claws it back, roaring higher, often stronger, with renewed conviction. That, my friends, is not just a price swing. That's the heartbeat of this asset class. That's the brutal, beautiful truth of high-conviction markets in 2026. Today, I want to take you inside that chaos. What really caused the disappearance, why the recovery was so ferocious, and what it teaches every one of us about fear, opportunity, and the kind of resilience that separates survivors from legends in this space. Because if you've ever stared at a 40% day and wondered whether to hold or fold, this one's for you. Let's dive in. 600 billion didn't disappear. It was fear changing hands at light speed. Picture the order books in those frantic hours. Bids evaporating, asks stacking like dominoes ready to fall. 1 minute, the total crypto market cap sits fat and happy north of whatever peak we were riding. Then boom, leverage cascades, stops get hunted. Margin calls fire like machine guns. In a flash, positions worth hundreds of billions are force closed, not because the assets themselves vanished into some black hole, but because weak hands, over-leveraged degens, and panic-stricken retail hit the sell button at any price just to stop the bleeding. That money didn't evaporate. It transferred, from the scared to the prepared, from the leveraged dreamers who thought dips were for buying more, to the cold-blooded accumulators who had dry powder sitting on the sidelines, waiting for exactly this moment. Think about how these markets actually work. Crypto isn't backed by cash flows or physical collateral in the traditional sense. It's priced purely by what the next person is willing to pay. When sentiment flips from euphoria to terror overnight, the bid side thins out to nothing. A few large sells, maybe a whale unwinding, maybe ETF outflows accelerating, maybe macro news like tariffs or rate hikes spooking everyone, trigger algorithmic trading bots to pile on, widening spreads, triggering more stops. Liquidations. Snowball. 1 billion becomes 5 billion becomes $20 billion in forced sales within minutes. On-chain data lights up with millions of accounts getting wrecked. Exchanges' insurance funds get tapped. The chart goes parabolic down, and the headline writes itself, 600 billion wiped out. But here's the brutal truth nobody wants to admit when the red candles are screaming. Most of that wipeout is paper wealth anyway. Unrealized gains from the previous pump get realized as losses for the late entrants and the maxis who levered up at the top. The actual capital that left the system? A fraction. The rest simply changed wallets. The sellers dumped at despair prices. The buyers scooped at fire sale levels. Fear didn't destroy value. It redistributed it at warp speed. The weak conviction crowd paid the price for being overexposed. The strong hands, the ones who understood this game is cyclical violence, quietly loaded up while everyone else was hitting refresh on CoinMarketCap in disbelief. Look at the mechanics of those hours. High leverage on perpetual futures means tiny moves get amplified into cataclysms. A 5% dip can liquidate 20x longs en masse, forcing more selling, creating a self-reinforcing loop until exhaustion. Funding rates go negative, open interest craters. Then suddenly, the cascade stops because there's no one left to sell. The capitulation is complete. The bottom is in. Not because fundamentals changed overnight, but because the fear has been wrung out. The 600 billion disappearance was the market pricing in maximum pessimism in record time. It wasn't money gone forever. It was conviction shifting from the many to the few. And that's why these events feel so surreal. 1 hour you're watching your portfolio get gutted. The The next, bids start creeping back because the sellers are spent. The same liquidity that crushed prices on the way down reverses on the way up. Shorts cover, dip buyers step in, FOMO reignites for the survivors. Fear changed hands so fast it looked like magic or catastrophe. But it was just the market doing what it always does in high conviction, high leverage environments, punishing the unprepared and rewarding the patient. That transfer isn't theft or illusion. It's the brutal efficiency of price discovery in chaos. The $600 billion didn't disappear. It found new homes with people who weren't blinking when everyone else was. The fastest crashes produce the most violent recoveries. Chaos is the entry tax for legends. In the aftermath of every major crypto bloodbath, the pattern repeats with eerie consistency. The steeper the drop, the sharper the snapback. A gentle 20 to 30% correction might take weeks or months to recover from, grinding sideways in uncertainty while conviction wanes. But when the market decides to purge 40%, 50%, even 70% in a matter of days or hours, like we just witnessed with that $600 billion flash evaporation, the rebound isn't polite. It doesn't tiptoe. It explodes. Why? Because extreme fear compresses time. Normal markets digest information slowly. High conviction, leveraged ones like crypto, do it in hyperspeed. When sentiment collapses that violently, it forces out every last weak hand, every over-leveraged position, every tourist who was here for the quick flip. The capitulation is total. Open interest collapses. Funding rates flip deeply negative. The chart hits levels that were unthinkable just days prior. And in that vacuum of sellers, the buyers who were waiting, who actually believe in the long-term thesis, step in with size. They don't nibble. They devour. Shorts get squeezed mercilessly. The same leverage that amplified the downside now works in reverse. A 5% bounce off the bottom triggers cascading covers, forcing more buying. Dip buyers who average down at the lows see unrealized gains turn green fast, encouraging them to add more. FOMO creeps back in for those who sat on the sidelines or sold too early and now regret it. The velocity of money returning to the system is ferocious because the pain was so acute. The market doesn't just recover, it overshoots to the upside as conviction rebuilds on steroids. History is littered with examples. March 2020, Bitcoin drops from speculated 9K to under 4K in days amid global pandemic panic, over 50% wipeout. Then it roars back, never looking back, embarking on the cycle that took it to 69K. May 2021, another brutal flush, 50% BTC drawdown in weeks. Recovery, violent multi-month grind, higher into new highs. November 2022, FTX implosion, 20 to 30% overnight drops multiple times, total market bleed of trillions in perceived value. Bottom found quickly, then relentless climb through 2023-2025 bull phases. The pattern is clear. The deeper the scar, the stronger the healing. Chaos doesn't just shake out the weak, it resets the risk-reward dramatically. At the absolute nadir, when headlines scream, dead, the asymmetry is insane. Buying at perceived end of the world. Prices means even modest conviction pays off massively when sentiment flips. That's why the fastest crashes birth the most violent recoveries, because they create the widest dislocations between price and underlying belief. And make no mistake, surviving that chaos, holding through it or buying more, isn't luck. It's the entry tax. You pay with emotional capital, with sleepless nights, with the sting of watching unrealized gains turn to dust. But those who pay it willingly, who see the violence not as destruction but as opportunity creation, become the legends. The ones whose portfolios compound at rates that look impossible in hindsight. The ones who look back at these moments and say, that was the gift. Because in high conviction markets, chaos isn't the enemy of progress. It's the mechanism that clears the path for it. The entry tax is steep, but the dividend is asymmetric. Those who refuse to pay it stay on the sidelines forever, watching others collect the outsized returns. Those who do pay, through discipline, dry powder, and unshakable thesis, get front-row seats to the most explosive moves this asset class has ever produced. The faster the crash, the higher the tax feels in the moment, but the richer the reward when the recovery ignites. In high-conviction markets, capitulation is not the end. It's the signal the smart money has been waiting for. When the selling pressure reaches its peak and the last weak hand throws in the towel, that's not the funeral, it's the starting gun. Capitulation is the moment the market has finally exhausted the supply of panic sellers. Every forced liquidation, every margin call, every emotional dump at rock-bottom prices has cleared the field. The order book is stripped bare on the bid side. Then suddenly, there's no more fuel for the downside fire. That's when the smart money, the institutions, the whales, the conviction holders who've been accumulating quietly or sitting on cash, starts to move. They don't announce it. They don't tweet about it. They just buy, aggressively. Because at that exact point, the risk-reward has flipped to absurd levels. The price is detached from the underlying narrative. The thesis hasn't changed. Adoption is still accelerating. Network effects are still compounding. Fundamentals are still improving in the background. But perception has been crushed to despair levels. The crowd sees apocalypse. The prepared see asymmetry. This is where the transfer of wealth happens most efficiently. The fearful sold to the fearless. The over-leveraged got liquidated into the hands of those with dry powder and iron stomachs. Capitulation isn't random noise. It's the market's mechanism for price discovery at extreme sentiment. When everyone who was going to sell has sold, the path of least resistance reverses. Shorts cover to protect profits or cut losses. Longs who held through the storm see their positions green again and add. New money, smelling blood in the water, piles in. The recovery isn't gradual, it's violent because the compression was so severe. History proves this over and over. In every major crypto cycle, the deepest drawdowns preceded the most explosive legs up. The 2018 bear market bottomed with capitulation in December. Bitcoin bled to $3,200 after months of grinding lower, sentiment at all-time lows. Then the 2019 recovery kicked off, followed by the 2020-2021 bull. The 2022 crash after Terra Luna and FTX saw multiple capitulation events. Each flush lower cleared more weak hands. Each bottom held firmer, until the market finally turned in late 2022, early 2023, and never looked back through multiple all-time highs. Even in traditional markets, the principle holds. The 1987 Black Monday crash, 22% in one day, pure panic. Recovery was swift and strong. The 2008 financial crisis had several capitulation moments. Lehman, October lows. Each one marked the transfer to patient capital before the multi-year bull run. Capitulation signals the end of distribution and the beginning of accumulation by those who matter. In crypto specifically, because of the leverage, the speed, and the retail-driven nature, these signals are louder and clearer. The on-chain metrics light up. Exchange inflows peak then drop sharply. Realized losses hit records. Long-term holder supply starts increasing again. Funding rates go extreme negative, then snap positive. It's not subtle. The smart money watches these indicators like hawks. They know capitulation is the green light. The beauty is in the psychology. Most people see the bottom as terrifying. Prices lower than they've ever been in the cycle. Headlines apocalyptic. Friends and family calling it a scam again. But that's precisely why it's the opportunity. The crowd is wrong at extremes. When conviction is tested to breaking point and holds or rebuilds, the move higher is ferocious because doubt has been purged. The remaining participants are stronger, more aligned, more diamond-handed. So, when you see the chart go vertical down, when the fear index is off the scale, when people are swearing off crypto forever, that's not the end of the story. It's the chapter break. The smart money has been waiting in the shadows, patient, for exactly this signal. Capitulation isn't defeat. It's confirmation that the shakeout is complete. The weak are gone, and the real move, the one that prints generational wealth, is about to begin. The $600 billion flush we just witnessed wasn't random destruction. It was the purge that set the stage for the next leg higher. The capitulation candle is the buy signal disguised as Armageddon. Those who recognize it, who act on it instead of freezing or fleeing, are the ones who end up owning the recovery. In these markets, the bottom isn't found by hope. It's found by surrender. And when surrender is universal, the smart money knows the game has flipped. They load up while the world despairs, because capitulation is their cue. It's the moment conviction pays the highest dividend. So, there you have it. We've walked through the fire, 600 billion vanishing in hours, fear ripping through every screen. Capitulation so loud, it drowned out reason itself. And then, the roar back. The violent snap that turns despair into dominance. The brutal reminder that in these markets, chaos isn't the enemy. It's the filter. It's the tax. It's the forge that turns paper-handed tourists into diamond-handed legends. What separates the survivors from the stories isn't luck. It's conviction tested in real time. It's dry powder when everyone else is bleeding. It's the stomach to stare at red candles and see opportunity instead of obituary. Because every major flush we've lived through, 2020, 2021, 2022, and now this one, has done the same thing. Shaken out the weak, rewarded the prepared, and launched the next parabolic leg higher. This isn't just about surviving the next dip. It's about thriving in them. It's about recognizing that the scariest moments are usually the most profitable ones in hindsight. So, when the next wave of fear hits, and it will, remember this. The $600 billion didn't disappear forever. It changed hands. And the hands that caught it were the ones that didn't flinch. If this resonated, if you're still here holding, buying, or just trying to understand the madness, drop a like to let me know you're in the fight. Subscribe if you want more breakdowns like this. No fluff, just the raw truth of these markets. And comment below. What was your move during the chaos? Did you panic sell, diamond hand, or load the dip? Let's see who's building real conviction out there. Stay sharp. Stay convicted. The game isn't over. It's just getting started.